Welcome back, everyone, to episode number 33 of the Ahsan Raza podcast. I've got a very special guest on the show today, which is Sibtain Panju, and I'm going to give a brief background and description of what he does and who he is. Sibtain is the founder and the CEO of PRAGMA Inc. and manages an 8-figure portfolio. PRAGMA helps professionals and family offices protect and grow their wealth through real estate investing. Many of their multifamily value add projects result in doubling the value of the property. They help bring quality housing to Canadians, and on a monthly basis, they also donate a portion of the proceeds to causes such as providing education, clean water, and shelter to deserving families and also orphans. But perhaps most importantly, they want to support others to create passive income through real estate. So thanks, Sibtain, for coming on the show. I appreciate it, man.
Great to be here. Thanks for having me on.
Thank you so much. So why don't you talk about your background professionally? What kind of motivated you to kind of get into multifamily investing specifically?
Yeah, so I've been, I followed the standard route. I went to the University of Toronto, did the Bachelor of Commerce there, did the CPA, CFA, and then I did a corporate job, like a 9-to-5 job for many years. I was in banking, corporate finance, and then I realized that this can't go on for too many more years. You know, like you pay a lot of taxes. Right. It's hard to build wealth. So, like over the years, we've invested in single-family homes. But a few years ago, we started looking at the multifamily strategy as well. We looked at different strategies, but we ended up with the multifamily strategy as the best way to build wealth going forward.
And so, what kind of differentiates the multifamily from your traditional single-family house, condo? What's the differentiating factor?
So when you look at multifamily, the value of the property is based on the income of the property. So the rent minus the expenses. Right. So say the rent is $200,000, the expenses are $100,000, and the profit's $100,000. The value of the property will be roughly a multiple of 16 to 24. So that property might be worth roughly $2 million. Right. As the rent goes up, the property for the multifamily property increases. With single family, the property value is based on the comparative. So the economic fluctuations, whether it's interest rates, whether it's GDP, whether it's inflation, they all impact the market. There's market correlation, which can bring the value of the property down. And then secondly, there's the economies of scale. So you only have one roof, you only have one driveway, you only have one lawn to mow, right? Right. So the cost structure is a lot lower on the multifamily side of it. So therefore, your cash flow and your profits are a lot higher.
Yeah, and I also assume that like with single family or condos, especially in the GTA right now, it's not always cash flow positive, right? So there's always a ceiling for that rent, but especially with this high interest rate environment, it's kind of tough to cash flow, especially in the GTA.
Exactly.
So multifamily kind of offsets that a little bit with more cash flow, I would assume.
Yeah, but with multifamily, the cap rates, the cap rates are basically your net income divided by the price of the property. Right. The cap rates are typically between 4 and 5. Okay. Whereas in the GTA, the net income to price ratio is more like 3%, right? Can
you share a success story from one of your multifamily investment projects currently or in the past?
Sure. We have different multifamily projects. Like a lot of them did pretty well. Our strategy is we purchase a property that's underperforming. Okay. We renovate the property, and we increase the value through renovations, and we increase the rents as well, which then drives up the value of the property. Right. So one or two properties that we've done this with is one's in Kingston, one was in St. John, for example. Okay. The Kingston property was 16 units. We purchased that property about 3.5 years ago, and essentially we renovated the property. It needed everything from windows to roof to mini splits, new kitchens, new bath. We turned over 90% of the building, and we increased the value by double within about 18 months. Okay. So we refinanced that property. What we do is we have capital investors that come in. They invest in the property, and then once we raise the value of the property, we refinance the property, give them their capital back, right. And then what happens is they still own the share of the property, which will grow infinitely. So you talked about, for example, Kingston and St. John's. You obviously did your research with those cities. So what are like some key factors that you guys look at when selecting a multifamily? And then for the investors, like what would you say is a typical minimum investment required, and what's the rate of return that they would typically get on that investment? Yeah, good question. So some of the key factors we look at are vacancy rates. Right. We look at the population growth in that area. We look at the GDP. We look at some of the infrastructure projects happening in that city. Right. With Kingston, the vacancy rates are below 2%. With St. John, Fredericton, Moncton, these places are 2 to 3% vacancy rates as well. So there's a lot of demand for housing in these places. Right. So we'll look at those factors. We'll also look at the rent to price ratio. So we typically invest in secondary markets. And the reason we do that is we don't want to speculate. We're cash flow based investors. So we try to invest in properties which are cash flow positive. So in case the market does take a downturn, you can still hold the property forever because it's positive cash flow. You're not feeding the property.
Yeah. Just for our audience, like when you say secondary property, what does that mean?
So secondary markets are like Toronto would be a primary market. Right. Toronto, Vancouver, like major cities the big cities are primary markets. The secondary markets are sort of on the outskirts. The population is a little bit lower. But the cash flow is better in the secondary markets. Got it. So like London, Ontario would be a secondary market, for example, Hamilton, right? Right.
And then since you are going to these like secondary markets, like one of the, I would say, objections I get from people, even I had them before, was these properties are farther away. So it's going to be hard to manage them. It's going to be hard to find tenants. What if I don't get good tenants because I'm not close to home? So how do you navigate those challenges in the multifamily investment sphere?
Yeah, so we have we've sort of built out our power team. Right. We're part of various networks. We have property managers, we have contractors, we have realtors, who are our boots on the ground for these properties, right? So we don't have to be at the property every month, etc. Right? We'll just rely on our team, and then with video nowadays, we'll look at things through video surveillance as well. And then on top of that, I mean, we can always get there pretty quickly, right, through a short flight. So we'll go tour the properties periodically, but we have boots on the ground on site.
And then for, let's say, like a first-time investor who is looking to get into multifamily for the first time, like they've done their single family, they've done their condos, but now they're looking to get into the multifamily, right? What would you say are some advices you would give to that new investor who's kind of hesitant to jump the gun and get in? But what are some tips you can provide to them?
Yeah, I think the first thing is do some training and mentoring with people who are investing in multifamily. Speak to a lot of people, like from where you are to where you want to be. Try and find somebody who's already where you want to be and talk to them, right? Yeah. Secondly, to learn about multifamily, you have to walk through a lot of properties. You have to just pound the pavement, walk through the properties, learn about them. And then the third thing is to crunch a lot of numbers, right? So once you, like, it's a numbers-based game. So once you learn about the properties, learn about the markets, then what you can do is crunch the numbers on the deals and see which deals are profitable. So you'll quickly get to know through talking to various people what's happening in that market, what the rents are, what the profit should be, what the cap rate should be, and then basically the shortest way to do it is to partner up with somebody who's in the game, right?
Right. I guess quick question on that front: when it comes to the interest rates right now, are you still seeing a good enough return with the rates currently, or is it kind of come down?
Yeah, a bit? I mean, it's definitely come down because the net income goes towards debt service, and then you have the cash flow at the end, right? So over the past few years, the cash flow was great because we had mortgages of 2.5%. Right. We still have a few of those, but now the mortgage rates are closer to like 5% with CMHC mortgages, right? So previously we were doing bank loans. Right. Which were, the fees are lower on the bank loans, but then the rates are higher compared to CMHC. But now we sort of switched the strategy to CMHC investing, where, the CMHC has great incentives for energy efficiency and affordability, accessibility. So we're doing more CMHC investing now, where it's like a 5% rate, or even 4.5% sometimes, but with a longer amortization. So we still get the cash flow. Right. So we're looking for deals that are cash flow positive, right? Because if it's a cash flow negative deal, then you got to keep feeding it, right? Yeah.
And that's the beauty of it, I think, because obviously a lot of people, I think, were hit hard with their single family residence, especially in GTA. Obviously, speculation is always a bit of a risky investment strategy. I mean, if it works great, right? But when it doesn't, it really hits you in the face hard, right? Like what happened with people this in COVID and whatnot, with rates going up. But one advice, like I always give to my clients, is you should always have a bit of a balance, right? Don't over leverage yourself and only buy single families, only buy condos, only buy pre-cons, because if rates go up like they did, it's going to burn you really bad, which is what happened to a lot of people. But if you have kind of a mixed portfolio or even if you kind of move more into the cash flow scene, even when rates go up, at least you're not losing money as you would in the single family condo investment, right? So that balance is really important. Which is why I like multifamily so much, because I think even in a high interest rate environment, you can still come out on top, right? With the rents, and rents are always going to keep going up, it seems like.
Yeah, and like over the past 20, 30 years, rents have always gone up on average by like inflation pretty much, right? And multifamily is also great because of the inflation that we're seeing right now, right? So real estate in general is a good inflation hedge.
Yeah.
But multifamily specifically is basically the rents go up and your price of the property goes up, right?
Yeah. And like you said in the beginning, with multifamily, it's like that asset really goes up in value down the road, right?
Exactly.
Which is huge. So that's a good thing to think about. Now, in terms of financing, with single families, condos, you go through the traditional, conventional route for financing. How does it work for multifamilies? Is it the same traditional, conventional way, or is there a different financing strategy for that?
So like past few years, we were using bank financing, conventional financing. We were doing the standard like Bank of Montreal, for example, or Royal Bank, CIBC. But over the past couple of years, since the interest rates have been going up, we're doing more CMHC based financing.
Okay.
And CMHC, you have certain criteria you have to meet, but it gives you longer amortizations, it gives you higher loan to value ratios, and the rates for CMHC are based on the Canadian bond market rate.
Yeah.
It's not based on the regular prime rate. And the prime rate to bond market rate spread is pretty high right now, because the bond market rate factors in the long-term yield curve, and long-term rates are supposed to go down. So the bond market rate's a lot lower.
I think one question we missed out on was if somebody wants to invest into multifamily with your team or anybody, what is the minimum investment required, and what's the return on investment for them?
The minimum investment we say is about $100,000. Okay. Like typically our check sizes are bigger than that, because we're dealing with professionals and some family offices.
Right.
But we say it's about $100,000. In terms of returns on investment, the returns on investment for the first few years are about 20%. Okay. But then what happens is we refinance the property once the value goes up, give the capital back to the investor, and then the returns are infinite because you have no money in the deal, but your value of the property is increasing and you're getting cash flow. Right. So for the first 4 or 5 years, 3, 4 years, it's going to be about 20%, give or take. Yeah. And then after that, it's infinite returns.
That's a fairly good return. That's it. So you talked about some regions like Kingston, St. John's. What are some other markets and regions that you're looking at right now that you would say this would be a good place for a multifamily?
Yeah, so 3 provinces we're sort of focused on right now. We're focused on Ontario. We just bought a property last month, or in December, in Peterborough. Again, a secondary market, but very low vacancy rates. Peterborough has vacancy rates of 1.5%. We also have properties that we've acquired recently in Fredericton, St. John, and Moncton areas. Okay. And those markets also have 1.5% vacancy rates, and the cash flow is pretty good relative to the price. And then we also have a property in Edmonton. We're looking at the Edmonton market, the Calgary market as well. Those rents have been going up over the past year and a half, 2 years, and those properties are doing pretty well. And you can get a 5 cap in Edmonton, for example, and the rents are still increasing, right? And Calgary has been going off the charts with the rent increases over the past year and a half, 2 years.
Yeah, no, I've heard that a lot for Alberta actually, where a lot of people from Ontario are moving there too right now because it's so expensive over here.
Exactly.
But the rent rates there are going up. I'm not too sure about how the appreciation is in Alberta, but I mean, if you're cash flowing positive, then that passive income, it's yours, right? In terms of so we talked about the different cities, but in your journey through this multifamily investment journey, can you talk about some of the lessons that you've learned over the years, even some of the mistakes that maybe you went through and you had to overcome? What was that like?
Yeah, I think the biggest lesson is I should have started investing in multifamily about 20 years ago.
Yeah.
No, but in terms of lessons learned, I think there's been a couple of very simple lessons. One is when the mortgage rates are what they were a few years ago, like just buy into long-term mortgages, like lock in your mortgage for like 10 years if you can, right? Because we had some mortgages at 2.5%, and we locked them in for a few years, but not long enough, right? The second lesson is don't speculate. If you're buying properties, buy cash flow positive properties. If you're buying something like a pre-construction condo, for example, it's very susceptible to market fluctuations. We've seen interest rate changes. We've gone through COVID, right. So it's hard to predict what's going to happen. But yeah, I mean, just buy something that's cash flow positive, and that way, in the long run, you'll be okay.
Right, gotcha. So, I mean, if you guys are looking for any multifamily investment opportunities, Sibtain is the guy to go to, and you can reach out to myself or even Sibtain, and we can definitely connect and get you some more information. So that's it for the real estate questions. Wanted to ask you some other questions on the personal side to get to know you a little bit more.
Sure.
So I was going to ask you, first of all, your favorite place to travel.
Favorite place to travel? We've been to Cancun a few times, so I'm going to say either Cancun or a cruise.
Okay. Nice.
I enjoy cruising. The whole family doesn't share that view. The majority of the family does, but not the whole family.
Right.
But Cancun is one of my favorite beaches, where it's got the waves, it's got the blue water, and the food's good. The people are nice.
Nice. I got to ask you about the MJ versus LeBron, because we've been getting a lot of guests that have opposing views. What are your thoughts? Who's the GOAT?
You know what? I've always been a Michael Jordan fan.
Yeah.
Like LeBron has some great numbers. Don't get me wrong, and he's a phenomenal player. But the grace and flair that Michael Jordan has, I don't think LeBron can match that.
Yeah, I think you had to be alive to see what he could do. So a lot of the new guys, I haven't seen him play. Obviously, we're going to go for LeBron, but you and I saw Jordan in his prime, so obviously
that's right.
We know what he was all about. Last question is, what's the best piece of advice someone gave you?
I think the best piece of advice someone gave me is between, I think I mentioned earlier, between where you are and where you want to be, there are people, right? So connect with people, partner with people, meet people, and they will help you out, right? Yeah. And that's how we all grow, through collaboration, right?
Yeah, and that's how we met. I mean, we were chatting on WhatsApp in a local WhatsApp group that we were part of. And now we're sitting here talking about real estate, and who knows, the future is bright. So thank you again for coming on. I appreciate it.
Thank you very much.
Thank you so much for listening, guys. We'll see you in the next episode. Take care.